Good afternoon and welcome to MF Corner. I'm Sumaira Abdi coming to you live from my home this afternoon. And on the show today, we have two topics which are very, very pertinent for all kinds of retail investors. First up, the strategy that has worked for you for the last 2-3 years, will it continue working? Kirtan Shah of SRE says it's time to perhaps relook at it. Also, a little later on the show, Hemant Rustagi of Wise Invest Advisors will join in to tell us why retail investors, whether the DIY kind or those who have advisors, they just cannot afford to be complacent anymore. So first up, let me invite SRE's Kirtan Shah. Kirtan, thanks very much for joining in. And this is an important topic because most often what we hear is, why fix something if it isn't broken, right? So something that has worked for you, an investment strategy that investors might have been using for the last few years, why should I change it? Is there a need to do so? Let's begin with the equity portion.
Sumaira, thank you so much for having me on the show. So Sumaira, before I answer that question specifically on the equity front, I think the retail investors need to understand two very simple basic concepts of what is value investing and what is growth or momentum investing, like it is called. So while we talk about value investing, what happens is, let's say the stock is probably fairly priced as per the fund manager at 100 rupees, but it is trading in the market at 90, which is below the fair value of what the fund manager thinks. Such a stock is called a value investing stock. Growth, on the other hand, is probably a stock where the fund manager thinks that the fair value is 100, but the stock is trading at 120. Now, of course, the question is, why will the fund manager buy it at 120? The reason the fund manager buys it at 120 is probably because the fund manager believes that the stock has a very strong earnings growth. What it means is that the company will keep earning much higher profits over a period of time, and hence over a period of time the stock will look less expensive, right? So value is one and growth or momentum investing is another strategy. Now, for us to understand why what has worked in the past may not work in the future is for us to understand where does value work and when does momentum strategy work. Look, they work in a cycle, not just in India, globally as well, not just in the short term, but long term as well. So if I have to quote you some data points, let's say globally in the US, I was reading an MSCI report which said that, between 1989 to 1999, you saw basically the growth stocks go up and the value underperform significantly. That was exactly the time where the markets were climbing, right? And suddenly after 2000, when the markets were supposed to fall, you saw value strategy work and growth not work. So when does value work and when does growth work? Growth typically works in a phase where the stock markets are rallying. So when the stock markets are rallying and stocks are going up, there is a less emphasis given on the valuation, and hence most of these stocks with higher earnings potential are bought into. But typically what happens is, at one point in time, when the valuation starts looking slightly expensive, that is when bargain buying or value buying comes into picture. Of course, this may look slightly in the hindsight, but what I'm trying to say is that while the markets are going up from bottom to peak, you will generally see momentum strategy working. But close to the peak, you will generally see more money getting invested in value than in momentum. Is this true in the Indian context also? The answer is yes. Why do I say so? Let me talk about the near term first. So in 2014, we had a rally, after which you saw in 2015 and 16, value strategy worked over momentum. Now, again, post that, you had 17, 18, 19, where markets again rallied, right? Which is why you saw in 20, also in 21 so far, you've seen value strategy work. In fact, for the FY21, you've seen all the 18 value funds that we have, they've all beaten Nifty. So the point that I'm trying to make is that not just in the short term, but in the Indian context also, if you look at what happened in 88, 89 or 2007, 2008, what we typically see is while the markets rally, you see momentum stocks or momentum strategies do well. But when the markets are fairly or richly priced or probably are close to the top, of course, you understand it in the hindsight, but that is when the value strategy starts working, is because then the funds or general investors will look at more value bargain than growth. So which is why I think that the rally that we've seen over the last 2-3 years have got the momentum strategies, the kind of return that they really got. But if you look at what happened in 2000 and already thus far in 2021, values picked up, and hence I believe that calls for some value allocation in the portfolio, Sumaira.
Okay, so then how do we go about this value allocation? I mean, do investors look at diversified funds where the fund manager is value oriented? And if so, how do we even find that out? I mean, how do you know which fund managers, favor the value approach?
Sumana, that's a very interesting question, because I'll tell you what. From SEBI definition on value and contra funds, there is no clarity, and you can have two AMCs managing the same funds very differently. Because unlike the other funds like the large cap, mid cap, multi cap, there is no proper definition for value or contra given. So of course, you can ideally go and start allocating some money of your portfolio to value and contra funds. But the other way around, let's say, for example, if a client is a slightly moderate risk taker and would only want to invest in, hypothetically assuming, large cap funds. Now, if there are three options given on the large cap side, in my opinion, now what will work is the one large cap fund whose portfolio price to equity and price to book is lower than the other two. So that in a sense can be a way that you can pick value over growth, where you can look at funds where their price to earnings or price to book ratio is lower than the industry average or other funds that they are comparing with, Sumera.
Okay. So equity seems, like there is a scientific way to approach it. What about debt?
So Sumera, debt also is something very similar. If you look at what has happened over the last 3 years, you've seen banking PSU funds give 8% returns. You've seen long duration funds give close to 9% returns. In fact, the gilt with 10-year constant maturity is given 10% return. Now, typically what happens in a retail atmosphere is you look at what the last 1 year, 2 year, 3 year returns have been, and then you start allocating. I think that is where retail may go wrong now, is because what you've seen that actually drove the returns in a long duration or a gilt with 10-year constant maturity generally over the last 3 years was the 10-year yield falling. So you had the 10-year yield 3 years back close to 8.3%, which actually fell down to close to 5.8 and now is back to 6.1. So you've actually seen the returns driven because the yields fell significantly over the last 3 years. In my opinion, yields have bottomed out. Yields will not go much lower from here, and yields are supposed to go slightly higher progressively over a period of time. And hence, what worked in the past for a gilt or a long duration may not work. So in my opinion, if you have a 3-year kind of an investment horizon, a corporate bond fund will make a lot of sense to stay invested in, or even a short-term debt fund. And if you have a very small horizon, I would typically suggest staying in low duration or money market funds, Sumera.
Okay, and Kirtan, we can't end this discussion about what to do with the portfolio without talking about gold, because most Indians would have quite a large chunk of allocation to gold. So, if there is a case for an overhaul both in equity and debt, is there a case for an overhaul even in the gold end of the portfolio?
So, Sumera, I think that case has already played out in my opinion. So, we've seen gold rally over the last couple of years, but lately we've also seen that gold actually fell for close to 19-20% from its peak. Now, what we really have to understand is gold in terms of price movement is significantly directly linked to dollar movement, because internationally we buy gold in dollar, and hence if dollar becomes expensive, the demand for gold falls, and if dollar becomes cheap, demand for gold is slightly better off. Now, because of our overall understanding or call for the next 2-3 years is that probably in hindsight we might realize this, but dollar does not look too strong, and we feel that the dollar probably might soften even from here, and hence we believe that gold is very decently placed at this point in time for some exposure, definitely. So we will continue to hold gold, and that's our opinion on gold investing.
All right, Kirtan, thanks very much for joining and, as always, explaining some of the nuances of mutual fund investing. Thanks a lot. A quick break on that note. On the other side, Hemant Rastagi of Wise Invest Advisors will join in to tell us why retail investors of any kind just can't afford to be complacent anymore. Stay tuned. Hi, welcome back. You're with MF Corner. Today the next topic that we're discussing is something which will be of great value to retail investors, and especially the DIY or the do-it-yourself investor, because for so long, we've been told that mutual fund is, something that you keep investing, keep investing for the long term. Don't even look at it at the end of, your time horizon, which could be 10, 15 years. There'll be a pot of gold sitting for you. But, things are changing. Not to say that, this is wrong. Yes, it is a long-term vehicle, but it is now a vehicle which requires periodic inspection. So Hemant Rastagi, CEO of Wise Invest Advisors, joins in to tell us how we can shrug off this complacent attitude that we as investors might have had so far, and how we can be more active participants in this mutual fund journey, especially over the longer term. Hemant, good afternoon, and thanks very much for joining in. So my first question to you is naturally for the DIY investors, the people who are doing it themselves, investing in direct plans, creating their own portfolios. A lot of the times we feel, and I may have been guilty of that also, is that I found a good fund, I invested the money, and that's it. Now I'll review it maybe once a year, sometimes a little more, and that's about it. Can we afford to be this complacent anymore?
Well, Sumera, absolutely no. At times as an investor, you may get a feeling that, investing in mutual fund is very simple. You have to just pick some off the shelf and start investing. In reality, Sumera, investing actually is a process. So it begins when you start investing, it ends when you achieve your investment goal. And the reason why it is ongoing is because we have different goals to be achieved over different time horizon. To me, I think investors have to actively participate in this entire process, and there are many aspects that they need to look at. It all begins with, straight away not going to the fund, but look at asset allocation. You need to decide what should be asset allocation, which means how much money should go into equity, how much should go into debt, how much should go into gold. And it doesn't end there. You need to rebalance it over a period of time. If at all you need to rebalance, the issue is how do we do that? How do we make this exercise tax efficient? The next aspect is once you've decided asset allocation, which are the best options that can get you the best from each of these asset classes? And equally important is what should be the allocation to each one of them? The next is that there are a number of domestic and global economic and geopolitical issues that will keep on impacting your portfolio. You need to analyze how those are making a difference to your portfolio. If at all there is a need to make any change, if at all, then go ahead and do it. If not, then you should know how to absorb this and see, and then move forward from there. Another important aspect, Sumera, is that you need to keep on increasing your investment amount as your income grows. Now, this requires a discipline, at least doing this exercise once in a year. Another important aspect that investors need to look at is how to keep emotions out of your investment process. We are all guilty of allowing our emotions to dictate our investment decisions. Now, that's one of the biggest risks as an investor you face. And then, there are always new opportunities which are emerging. So if you're doing it yourself, you need to be alert enough to see where are these new opportunities coming up, and whether these are actually suitable for you or not. So it's not just that, like I said, picking some funds off the shelf and being happy that, okay, I've invested in the mutual fund. There is a process that you need to follow. Yes, it may sound little overwhelming, but the reality is that if you're a disciplined investor, you understand the value of each of these aspects in the investment process, you can do a much better job. But yes, it is just not picking up some funds, but you need to be at it throughout your time horizon.
But Hemant, does this hold only for the DIY investor? What about people who have advisors? Because, you're paying an advisor to do the heavy lifting for you, right? So how much participation does that kind of an investor need?
Well, I think that's a very important question, Sumera. I think there is a lot of value in taking help of a professional advisor if you're not very confident about that you have enough time or you have the wherewithal to manage your own investment. If you don't have it, yes, you must hire a professional advisor. But the problem is that many investors, once they hire a professional advisor, they feel their job is over. So they completely withdraw themselves from the investment process. There are three aspects or three components of an investment process, right? You begin with earning, and then you have saving, and then you have investment. Many investors start thinking that, okay, let me now focus on earning money. Let me save as much as my investment advisor is saying. And the rest of it, investment part, let the advisor handle it, which is not obviously right. I think it's important to understand that even if you have a professional advisor helping you, there are certain parameters which are defined on what basis your investment is going to be. There, I think as an investor, you have an important role to play. Second, it's important for you to understand the process, even if you have a professional advisor. And what are these things you need to understand? How is my asset allocation happening? How are the funds being selected? What is the basis why some of the funds are continuing in that? Now, initially, again, it may sound a little intimidating, but the fact is that once you get involved in this process, you will start learning. You will then, wherever, suppose you are reading some article or watching a show and something is being discussed, you will have a better understanding. Now, take example, suppose you have a couple of large cap funds in your portfolio, and then you see that analysis which says top 5 fund, on whatever parameters it may be. If you do not find your funds in those, you should be asking a question to your advisor, why these funds are not there. And your advisor should be able to tell you why these funds are not there. Maybe they are missed out. That means they're not doing a good job. Or it could be that the funds have been very volatile, may not suit your temperament. So I think there has to be a reason for you, for them for not recommending these funds. So I think once you get involved, you start understanding, you become a better investor. It's equally important for you to understand how is advisor interest aligned to your portfolio? What is that they're getting out of it, whether they're working for themselves, whether they're working for you? It cannot happen unless and until you start actively participating in this process. So just because you have investment advisor, you take a back seat, I think that can be quite detrimental to your financial future.
Hemant, as difficult as it is creating a portfolio on your own, because, the more I study and research about mutual funds, the more I'm convinced that it is more a science than anything else. But nevertheless, I feel that the biggest stumbling block for an investor who's doing it themselves is that, if something goes wrong, you find it difficult to have your grievance, or your query answered, or, sometimes redemption may be delayed, sometimes units, may get processed late. So how does a DIY investor approach this? Because, you also have a day job.
Well, I think this is an important aspect. Many times investors, when they start investing in mutual funds, they completely ignore this. So if you're a DIY investor, you need to understand that every aspect of your investment process, as well as the servicing aspect, you had to tackle it yourself. Now, if you're doing it online, the life becomes a bit easier, whether it's a financial transaction or a non-financial transaction, whether you're investing, redeeming, switching, all this can be done online. Even if it is a service requirement, if there is a discrepancy, all that can be handled through the email. But the point is, if you're not conversant with that, if you're doing it physically, it becomes a bit difficult. Good thing though is that, the R&T agents, the register and transfer agents, and the mutual funds, they have investor grievance cell. There are other people who are really focusing on this. So if there is any issue with any of your investments, suppose there is some issue with your SIP, you will get a redressal. But you need to understand that it's a time-consuming affair. So you need to make sure before you decide whether you want to invest on your own or not, that one, we have already discussed what all you need to do in terms of tracking your investment. And this is the second aspect, that you must have time to kind of spend on this servicing requirement. If you're not, maybe you're better off hiring a professional advisor. But you need to understand these things are equally important, as important as your investment process.
Yeah, and this is not to dissuade people from doing it themselves. I'm all for people who want to take up the mantle. This is just to lay on the table that there is more to investing than just selecting the funds. And, you should be cognizant of the entire process and not just the process of filling your portfolio. And Hemant, finally, there are some 1,700 schemes running currently, right? the whole process of selecting a scheme is becoming so difficult because, you know, it's not just enough that you look at the top 5 fund houses, which is what, you know, we used to advise a few years ago, is that just look at the top 5, select one of them and you're done. A lot of the medium and smaller sized fund houses and schemes are giving outsized returns. So, you know, as an investor, you're just so confused or, you know, sometimes overwhelmed by the process of selecting funds. Therefore, isn't it just better to go the passive way? Should I just not be buying ETFs? I mean, for one, they're cheaper. And second, you know, I mean, I don't have this whole universe of 1,700 funds where I need to create a portfolio from.
Well, I agree with you. You know, Sumaira, I would say that there is no doubt about the fact that mutual funds are a very simple investment vehicle, but I think investing in them is not any more simple. And you've explained the reason very well. There are a number of funds available. I mean, if you really go by the categorization that SEBI has done, there are 16 categories of debt fund. There are 10 to 12 categories of equity fund. There are hybrid funds. There are goal-oriented funds. So clearly, it can be a little tricky. You know, as far as investing in ETF is concerned, I think there is always a case for indexing the portfolio. The issue is how much you do that and in what manner do you do that. Now, you know that the number of people who have Demat account in our country is still very small. So I think if you talk about ETF, then it's, you know, available to only those people. There is another way of indexing a portfolio is through index funds. So definitely there is a case for that. But I would say that, you know, ignoring actively managed fund altogether, I don't think that will be a smart thing to do. The fact is that whenever the market is narrow, or there are certain periods that we saw a couple of years ago, then you will see these ETFs and index fund doing better than actively managed fund. But the moment the market become broad-based, rally sustaining, okay, when you see the value investing doing better, or like I said, market becoming broad-based, you will see, you know, this actively managed fund creating alpha. So, and I think they will continue to do that. So I think that the right thing to do is to have a mix of these two. Anyone, I totally agree with you. We are not trying to discourage anyone from not going directly. The idea is to understand that, like I said earlier, it's not just picking a few funds off the shelf. Understand what goes into selection, monitoring, and everything, and then go for it. But if you're not comfortable, then take help of investor. But like I said, combination of passive investment and active investment. Of course, the proportion will depend on what kind of investor you are and what level of investing process you are. But I think a combination can work the best.
Got it. Hemant, thanks very much. And by the way, for everybody who's watching, you should know Hemant has been, you know, one of our guests now for the good part of 10 years, maybe even longer if I'm not wrong. Hemant, thanks very much. You leave us wiser at the end of every chat. Thanks very much, guys, for watching.
Thank you.
That's the end of MF Corner for today. Do stay tuned. The team of Closing Bell joins you next.